For those of us who've actually spent some time in the non-for-profit, you definitely acknowledge that the funding environment has actually changed. The days when organizations relied purely on traditional grants have faded, especially in the last year when USID funding came to an end and many other spirals that has happened from that particular end of that granting cycle. So today we are seeing something different, something more complex and something more powerful, a new breed of not-for-profit, if you ask me. And why do I say? Because I see it as one where grants are investors are actually sitting at the same table. And that is what has actually changed everything. So for nearly 2 decades, I have been working in nonprofit financial leadership. I have watched this evolution up and close, especially across Africa in global health, education, and even social impact portfolios. So what used to be relatively a straightforward model where I would apply for grants, manage restricted funding, report to donors, has now changed. It's now turning slowly to managing a blended capital ecosystem. So we are looking at philanthropy, we are looking at developmental finance, we are looking at private foundations, program related investments, and also recoverable grants, all interacting in the same organization. And so, coming from that background and understanding, today I want to unpack three things: why this shift is happening, what it means for financial strategy, and what separates organizations that will thrive in this model vis-a-vis those that will struggle. So let's start with the obvious question. Why are grants and investors sharing the table? Why is this happening at all? So there are three forces that I believe are driving this shift. One is first, the need to scale or the time for scaling. So traditional grants are powerful, as we know, and they have kept the work going for all the years, close to over 30 years. But what I have also come to learn is most of these traditional grants were never designed for exponential scale. But if you look on the other side, investors, however, think in terms of leverage, multiplication, and also replication. So when a social enterprise wants to move from, let's say, serving 10,000 beneficiaries to 1 million, grants alone will not carry that ambition. That's where now investments and blended capital starts to come in. The second thing that I think is bringing this drift is accountability for outcomes. Donors increasingly want measurable, tangible impact. That has been the design, that has been the tradition. But if you look at investors, they are actually not looking for it, they are demanding. They are demanding to see it. It is their language of understanding their investment in your social enterprise. So we are looking at impact matrices, unit economics. They are asking for what is the cost per beneficiary. They're actually looking for this kind of in-depth analysis. These were once the language that we knew were in the venture capital world. But as we move towards the blended capital in the non for profit or the blended funding, this is actually becoming something that is required. Investors are looking for beyond the measurable, tangible impact. They want things like unit economics and cost per beneficiary analysis. And so now this kind of analysis have to be embedded in nonprofit boardrooms. The third item that I think is contributing to this shift is that there is growing recognition that pure grant dependency can create fragility. And we saw that when USID came to a halt, many organizations actually had to close shops and many people had to lose their job. And it's one thing that we've continued to track even in our risk registers in many organizations. The over dependency on one donor, but we also realize that some of our projects were designed just to meet one donor expectation. And so you find that when one major donor exists, organizations collapse, like I've just said, and then blended capital introduces this resilience. It because it requires that it is actually properly structured. But there's always a catch when you start moving to the blended grant and capital structure. So when grants and investors sit at the same table, they don't always speak the same language. And that's where finance leadership becomes strategic and not just operational. So let's look at what this means for financial strategy, especially for finance leaders who are leading financial strategy at scale. Because this is where many organizations understand they understand or underestimate the complexity. Because blending capital is not just about adding another funding source. If you look at it, it fundamentally changes your financial architecture. So let me break it down on how I understand. So one, you now have multiple risk appetites in one organization. So grant funders may prioritize, let's say, compliance and mission fidelity, but impact investors may prioritize return of capital and measurable efficiency. So one might be tolerant to slower deployment to ensure safeguarding of funds, and the other one may push for speed of scale. And so if your financial reporting system cannot clearly articulate both impact, performance, and financial performance, then definitely you're going to create tension. So sophisticated organizations build dual reporting fluency that still meet donor compliant financial statements, investor grade dashboards, cohort performance analysis, and also liquidity modeling. And this is not because it looks impressive, but because alignment depends on transparency. The second one is that in purely grant funded models, organizations often track budgets by line item. Their main language is the BVA report. They want to see how they are spending against the budgeted line items. But in the blended model, as a finance leader, you must understand what does it cost to serve one beneficiary beyond the budget analysis. What is the timeline of this impact value? And can this program ever reach its operational break even? Even if you are not for profit, your economics must make sense in this dispensation because investors are not allergic to mission. They're actually allergic to the opaqueness that reports can come with. And a strong nonprofit leader must understand that financial clarity is not mission compromise, but it is mission protection. So the third thing that drives this kind of shift is that grants often reimburse. Investment often require deployment milestones. Here is the practical tension because cash timing misalignment can quietly destabilize operations, and we know that when we do our cash flow tracking. So, in the new breed of nonprofit, it needs that there must be working capital buffers. You must have a scenario modeling that actually makes sense. You must be very clear in the distinction between restricted and your unrestricted grants. And then board must be able to have clear oversight on the liquidity at all times. Because we know blended capital increases opportunity, but it also increases complexity. So what really separates organizations that thrive in this kind of the model that we are moving into as nonprofits? So this is the part that actually fascinates me as a leader in this, as a financial leader in this sector. Some organizations step into blended capital and accelerate. Others implode under governance, conflict, reporting confusion, or strategic drift. So, what's the difference? So, from what I've seen, it comes down to three things, if you ask me. One is the strategic clarity before capital. Thriving organizations don't just chase capital or grant, they actually define their model first. These organizations know what is grant funded because it should always be grant funded. So they are very clear about that. What activities can responsibly generate and revenue, and what does catalytic capital unlock in the system change. They structure capital around strategy and not the other way around. The second thing that they do is that there is what we call governance maturity. So when investors enter the picture, governance shifts. So board composition must evolve, risk conversations must deepen, and performance oversight intensifies. So if your board is not financially literate, tension escalates very quickly. Some strong organizations invest actually in governance education. They create shared language between philanthropists and also investors. Because blended capital without governance alignment is like putting two CEOs in one seat. And I know there is also the current model of co-CEO, but that's different. The number three, that something that I can also allude to is that financial leadership must think about the architecture. This is perhaps for me the most important point. In the old model, finance leaders ensured compliance, which is okay, which is required. But in the new model, finance leaders must design the systems. We are no longer just reporting history, we are modeling the future, designing capital stacks, assessing leverage ratios, balancing mission integrity with capital efficiency, and doing so calmly, transparently, and strategically. Because when different capital systems and types share a table, someone must definitely be able to translate. So my curiosity is, let me leave you just with one thing to think about. What if the real evolution is not about capital at all? What if it's about discipline? Because blended capital forces nonprofits to sharpen strategy, clarify impact, strengthen governance, and elevate financial management. Perhaps this new breed is not defined by who funds them, but how they understand themselves. So if you're leading or you are an inspiring lead in this space, it would be important to understand that blended capital is not a trend. It is a structural shift in social impact finance. And the organizations that will define the next decade are not the loudest. They are the ones that have the most architectural sound financial systems. They understand their cost structure. They respect capital alignments. They build reserves and they communicate with precision. And these organizations recognize that when grants and investors share the table, finance is no longer a backstage, it is a strategic leadership. So if this perspective resonates with you, especially if you're navigating donor funding alongside private philanthropic capital and impact investment, I'd love to hear what tensions or opportunities you are seeing in your organization, because I believe this conversation is just beginning and the new breed of nonprofit is still being written. Thank you for listening and Let's connect in the next video.